Okay, in this section we're going to be talking about risk and losses. Now keep in mind, this isn't as a boring or scary subject as it sounds. First of all, risk and loss is part and parcel of trading. And one of the things that you have to get straight away is that if you're going to trade, you will take losses. The aim of a professional trader is to minimize those losses to as large a degree as possible. And here's what I mean. First of all, we need to take a minimum amount of risk. What that means is, how much of your account are you going to risk on any one trade? I use a maximum of 3%. Now let's take a look at what that means. If we're going to risk, let's say you've got $2,000 to trade with, and you're going to risk 3% of it. So 3% times $2,000 equals $60. So you know on any one trade the most you can risk is $60. Now this will make sense as we go through the course. What I want to do is give you a background to it now so you'll have the information as we move forward. Remember, you want to get the concepts as you move through this course because we're going to be building one on the other. The risk and this risk calculation here plays into every trading example I'm going to use. So if you can risk $60, let's take a look at a hypothetical example. Let's say we're looking to trade the pound at 9,500. And we look at the market and we've said that our stop is 30 pips lower, so that would be 94.70, right? There's 30 pips difference here. 30 pips. What we can tell now is exactly what size position we could put on. Let me give you an example. If we're trading a mini lot, that means every pip equals $30. Whoops, I'm sorry. Every pip equals $1. I was reading it over here. So if we're risking 30 pips and we're trading one mini, that equals $30 worth of risk, right? Because we're risking 30 pips times $1 equals $30. So if we're going to risk no more than 3%, that means the most we can trade is 2 mini lots. Remember, we have 2 mini lots, so if each mini lot then equals $2 times 30 pips equals our $60 maximum. So now we know exactly how much we can trade. If we're risking 3% of $2,000, $60. If we're trading based on a 30 pip stop loss, that lets us put on 2 mini lots. Now, just so you know, there's also what's called a micro lot. A micro lot is 10 micro lots equal 1 mini, which means we could trade 20 micro lots. And I'll get into the reason why you might want to do this later. It's easier to factor your positions, get in and out, and take profits as the position starts moving. So I'm going to mention this now. Just remember, I'm going to get into this later. So that's one aspect of risk. Okay. The other aspect of risk and losses that we need to cover is how we're going to manage our money as we move along. So why are we picking 3%? Well, if you think about it, if you're risking 3%, that means you'd have to lose 33 times in a row in order to lose all of your money. This is called the risk of ruin. Risk of ruin. That's a lot. And let me tell you, you would be hard pressed to literally lose 33 times in a row. It's possible, but you would have to work at it. If you follow all of the rules that I lay out for you in this course, I would have to say it would be impossible for you to lose 33 times in a row. So let's take a look. Let's take a look at how some of this will actually pan out. And we'll start looking at real numbers here. If we're trading, we'll use our example of 2 mini lots. And we trade 20 times in a month. These are the base numbers. Now, I'm not saying that every month we're going to have exactly trades. Some months we may have a lot less. Some months we may have a few more. It's just every month is going to be different, okay? But let's use these as a base number. So 2 mini lots times 20 trades. And we're going to use this hypothetical example of 50% winners. What we know is if we're winning 50% of the time, we have 20 trades. All we need to know next is what are we going to expect to win or lose. And I'll go through this as the course progresses. Right now, just let's get the concept down. Let's say hypothetically, for every $1 we risk, we expect to make $2 in reward. This is called a 1 to 2. Some people would say a 2 to 1 risk-reward ratio. So for a reward of $2, they will have a risk of $1. Just keep that in mind. We're risking 1 to make 2. Now, at this 2 to 1 reward to risk ratio, that means for every winner, remember we're talking about these 2 mini lots. For every winner, we're going to be making 4. For every loser, we're going to be giving back 2. If we take 20 trades during the month, okay, that's a total of $80. But if we're giving back $2 for every 4 we make, multiply this out, $40. So at the end of the month, there's $40 in profit. Now I'll go through it again. We're taking 20 trades in the month with 2 mini lots. Remember, 2 mini lots equals $2 per pip. If we win half of our trades, and every trade that we risk $1, we make 2. Trading 2 mini lots, that means we're risking $2 to make 4. Over 20 trades, we have $40 of risk, $80 of reward, which means we're netting out $40. This is called positive expectation. It simply means that over a string of trades, you expect to make more than you lose. That's why we're not going to risk $1 to make $1, or we're not going to risk $1 to make 50 cents. These types of trading ratios don't work, especially for beginning traders. As a professional, we want to make sure that we have probability on our side, because look here, even if we have a terrible win-loss ratio, we're only winning 50%. As long as we can stick to a 2 to 1 risk-reward at the end of the month, we're going to come out ahead. Now, why do we do this exercise? Why is this exercise important? It's important because we never know where the market's going to go. Once we've entered a position, we can only manage our risk. So managing risk and managing losses are the two areas where you can impact your trading the most. Now, we're going to go through some more detailed examples later on, but you need to understand that basic concept so you can understand the examples I give later. I do explain it later on in the course, so don't worry about that. I'll explain the 3% rule. I'll explain how to use your stop, how to calculate the 2 to 1 risk-reward ratio, how to exit positions. All of that will come later. But you've got to understand these basic concepts first. Why we're picking a 3%, what a 2 to 1 risk-reward ratio means. You've got to understand that before we move on. So if it's not clear, go ahead and jot your questions down. shoot me off an email. We'll schedule some time to get on the phone, and I'll work with you one-on-one to make sure you understand this. Just keep in mind, we do explain it later on. So if you've got a good handle on this, then go ahead and move forward in the sections. Otherwise, you can, after this section is over, go ahead and pause, jot your questions down, and get in touch with me, and we'll go over it. What we're going to cover next is some of the setup, what you need to get started with this. We're going to talk about your computer, your internet connection, and also some of the software that's available on this disk.